Welcome to CPA Mastery. In this first lesson, we're starting with one of the most important tax concepts in the entire REG section: gross income. Almost every individual tax calculation begins here, because before you can compute adjusted gross income, taxable income, or tax due, you first need to know what income actually gets included. In this video, we'll use a simple working mindset. If a taxpayer receives an economic benefit, it is usually taxable unless the tax code specifically excludes it. That single rule will help you answer a huge number of REG questions. We'll walk through the definition, review the main categories of income, look at one classic exam trap, and finish with a simple strategy you can use on exam day. In this lesson, we have 4 goals. First, we want to understand the official definition of gross income under Internal Revenue Code Section 61. Second, we want to recognize the common categories of income that appear over and over on the CPA exam, including compensation, interest, dividends, business income, and capital gains. Third, we want to remember that not every receipt is taxable, because some items are excluded by law. And finally, we want to build an exam process that is fast and reliable. If you can look at a fact pattern, identify the economic benefit, and then check for exclusions, you'll make much better decisions on REG multiple choice questions and simulations. The starting point is IRC Section 61. The code says that gross income includes all income from whatever source derived. That wording is intentionally broad because the IRS wants the baseline rule to capture almost every form of economic gain. For the CPA exam, this means your starting assumption should usually be that an item is taxable. Do not begin by asking whether something feels fair or unfair. Instead, begin by asking whether the taxpayer received something of value. If the answer is yes, then the next question is whether the tax code specifically excludes that item from income. A very practical way to think about income is the economic benefit principle. If a taxpayer receives something that clearly increases their wealth, the IRS generally treats that as income. Most students think of income as cash, but that is only part of the story. A taxpayer might receive property instead of money. They might receive services instead of cash. They might even have a debt forgiven. On the exam, stay flexible. The form of the benefit can change, but the underlying question stays the same. Did the taxpayer receive measurable value? And does any exclusion remove it from gross income? These are some of the most common categories the CPA exam will test. Compensation income includes wages, salaries, bonuses, commissions, and tips. Interest income comes from savings accounts, bonds, and other lending arrangements. Dividends come from corporations. Business income comes from operating a business, often reported on Schedule C for individuals. Capital gains come from selling property for more than basis. You do not need to memorize this as a random list. Think of it as a map. If the exam asks where income came from, it usually fits into one of a few familiar buckets. The more quickly you can identify the bucket, the easier the tax treatment becomes. Compensation for services is the most common form of income. If a taxpayer works and receives payment, that payment usually belongs in gross income. This includes regular wages and salaries, but it also includes bonuses, commissions, and tips. A common exam mistake is to mentally separate bonuses or tips from wages. Don't do that. They are all forms of compensation for services. So if a taxpayer earns an $80,000 salary, receives a $10,000 bonus, and reports tip income, those amounts all get combined when determining gross income. Interest income arises when the taxpayer lends money and earns a return for allowing someone else to use that money. For REG purposes, most interest income is taxable. Bank account interest is taxable. Corporate bond interest is taxable. Treasury interest is generally taxable for federal income tax purposes, even though state treatment can differ. The big exception you want to keep in the back of your mind is municipal bond interest. That is one of the classic exceptions that students are expected to know. We'll highlight that again in the exam trap slide because it appears so often. Dividends are payments made by corporations to shareholders. The key point for this lesson is that dividends are income. Even when a dividend qualifies for a lower tax rate, that lower rate does not mean it disappears from gross income. This is a good example of how students can mix up inclusion and rate. The inclusion question asks whether the item is part of income at all. The rate question asks how heavily that income is taxed. Qualified dividends may receive favorable rates, but they still count as income. If an individual operates a business, the business activity can also produce income that belongs in gross income. For a sole proprietor, this usually shows up on Schedule C. The business brings in revenue, and then allowable business expenses are deducted to arrive at net business income. For this lesson, the main idea is that business activity creates taxable income just like wages or interest do. On the exam, watch for the difference between gross receipts and net business income. A business may collect a large amount of revenue, but what ultimately flows into the tax calculation depends on deductible expenses. Capital gains are another major source of income. The basic idea is simple. If a taxpayer sells property for more than its basis, the taxpayer has a gain. On the exam, the core formula is amount realized minus adjusted basis. Students sometimes get overwhelmed by all the capital gain terminology, but for an introductory lesson, keep it simple. First identify the sale, then compare the sales price, or amount realized, to basis. If the sale price is higher, there is a gain. After that, the holding period determines whether the gain is short-term or long-term. Let's put the concept into a quick example. Suppose a taxpayer earns an $80,000 salary, receives a $10,000 bonus, and earns $1,000 of bank interest during the year. All three items are taxable, so the gross income calculation is straightforward. 80,000 plus 10,000 plus 1,000 gives us $91,000 of gross income. This is the type of simple aggregation the CPA exam loves to test. The exam often mixes several ordinary income items together and asks you to identify the total amount that belongs in gross income. This is one of the most common reg traps. Municipal bond interest is generally excluded from federal gross income. That means it does not increase federal taxable income in the usual way. However, students often make the mistake of thinking that excluded means it never appears anywhere on the return. That is not the right mindset. Some excluded items still matter for reporting or for related calculations. So on exam day, remember the exact rule. Municipal bond interest is generally excluded from federal income tax, but it is not invisible for all purposes. Here's the simple process I want you to use on exam day. Step 1. Identify the economic benefit. Ask yourself whether the taxpayer received cash, property, services, or some other measurable value. Step 2. Check for an exclusion. Look for a rule in the tax code that specifically removes the item from gross income. If you do not find an exclusion, your default answer is that the item belongs in gross income. This process is simple, repeatable, and very effective. It keeps you from overthinking questions and helps you move faster through both multiple choice questions and simulations. Let's wrap up the lesson. Gross income is defined broadly under IRC Section 61. Which means most economic benefits will be taxable unless the tax code specifically says otherwise. The common income categories you need to recognize include compensation, interest, dividends, business income, and capital gains. Most importantly, do not approach these questions randomly. Use a consistent process. Identify the economic benefit first, then check for an exclusion. If no exclusion applies, include the item in gross income. That one method will help you answer a large number of reg questions with more confidence.